An estate is a separate legal entity created at death. That's the key trigger. The taxpayer dies, and now there's an entity that can own assets, earn income, and file returns. Don't confuse that with a trust, which can be created during life or at death, or a bankruptcy estate, which starts when someone files bankruptcy. On the EA exam, they love asking which event creates which entity. Probate is the court-supervised process of administering the estate. Whether probate is required depends on state law, so the federal exam focuses on the vocabulary and the authority. If there's a will, the court appoints an executor. If there's no will, the person died intestate, and the court appoints an administrator. Either way, that person is the personal representative who can act for the estate. With the IRS, you'll see executor and personal representative used loosely. The IRS often calls anyone filing for the decedent a personal representative, even if state law uses a different label. But here's the exam trap. The IRS won't just take your word for it. A simple statement like, "I'm the executor," is not enough. You generally need documentation like a court order or certified will. Right away, the executor has two startup tasks the exam loves. Get an EIN for the estate and file Form 56. Notice concerning fiduciary relationship. The EIN matters because the estate is its own taxpayer, bank accounts, brokerage accounts, and the Form 1041 use that EIN. Form 56 is how you formally tell the IRS, "I'm the fiduciary and I'm authorized to act." Think of the executor's tax job as three possible returns. First, the decedent's final Form 1040 covers income received before death, and you write deceased after the name. Second, Form 1041 is the estate's income tax return for income after death during administration. Third, Form 706 is the estate tax return, only if the gross estate exceeds the filing threshold, or if filing to make certain elections. Executor liability is the scary part. The personal representative is supposed to determine any estate tax due before distributing assets. If they distribute too early and later discover a filing requirement or tax, the executor can be personally on the hook. On the exam, watch for fact patterns where assets are paid out before appraisal or before confirming whether Form 706 is required. Two quick thresholds to keep straight. For estate income tax, the estate gets a tiny exemption amount, $600, when you're dealing with Form 1041 rules. For estate tax, the exclusion amount is huge, $13.61 million for 2024. For 2026 and beyond, the basic exclusion is generally $15 million per person, made permanent by ABA. And remember, Form 706 is due 9 months after death, with a 6-month extension on Form 4768. Practice question. A qualified disability trust, or QDT, is an example of what type of trust? Your choices include an abusive trust, an irrevocable trust, a grantor trust, or a revocable trust. Think about what a QDT is designed to do, and what that implies about control and reversibility. Think about it. The correct answer is an irrevocable trust. A qualified disability trust is set up to meet specific requirements and generally can't be undone at will, which is the hallmark of irrevocable. A tempting wrong answer is revocable trust, because many people associate disability planning with flexibility, but revocable means the grantor can freely change or cancel it. QDTs don't work that way. Practice question. The executor of a decedent's estate chooses the estate's accounting period based on which statement? The options include being forced into a fiscal year based on date of death, choosing calendar or fiscal year on the first return, needing IRS approval to use a fiscal year, or basing it on the decedent's birth date. Think about it. The correct answer is, when filing its first return, the executor can choose the calendar year or choose a fiscal year. Estates have flexibility, and the choice is effectively made by how the first Form 1041 is filed. The tempting wrong answer is that the estate must use a calendar year unless the IRS approves. Partnership vibes. But estates don't work that way.